This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. This week, opportunity and why it's getting harder to succeed on our own merits, and the companionship of our pets and how it's led to a multi-billion-dollar industry. We start with a story about prudence, about getting the balance just right in life, in business, and when it comes to managing money, knowing when to take risks, the right risks to take, and when to avoid risks altogether.
We obviously take credit risk and other risks, but people who operate in a community tend to know the good players and the bad players.
That's Bill Demchak, who, as CEO of PNC, manages risk for a living. PNC is one of the so-called regional banks that are at the core of the U.S. banking system. They're not as big as money center banks like J.P. Morgan, Bank of America, and Wells Fargo, which have assets of just under $10 trillion combined. But they can be much larger than the community banks catering to individuals and local businesses, which are less than $10 billion in assets each. PNC, for example, is one of the largest regional banks with assets of over $500 billion. For a critical segment of American business, regional banks get the balance just right. They lend to businesses like Perryman Company, a privately held firm based in PNC's hometown of Pittsburgh. The company has grown to become one of the top 5 producers of titanium in the world, and it's been banking with PNC since the very beginning.
We're what you would call a medium fish. We're not a big fish, but our track record is unmatchable in the metals industry, and we like our position where we're at. You know, we are very loyal. Our first meeting with PNC occurred in my parents' basement when we were just starting our company, and you know, it was over a couple of fold-out tables where the bank came in and we pitched our plan to them on what we were going to do. And along with our business plan, along with our ideas, our vision, our strategy, they said to my father, yes, Jim, we'll back you. And the relationship started there, and it's done nothing but grow immensely over the years.
Knowing its customers well over long periods of time helps the bank assess the risks it takes, but it can also make a regional bank a true partner for local companies when they face turning points in their businesses, as Perryman did when it moved to expand its world-class titanium business into melting operations and faced a challenge that might have taken it outside of Pittsburgh.
In 2005, we were at the point we needed to expand significantly in our capabilities. We needed more facilities and more land, which we were at the point of growing out of space in some of our campuses in this region. Well, we were having a very hard time getting additional land for this expansion, and we started looking at the state of Virginia. Well, in the 11th hour, I came to my executives here at PNC and said, hey, this is what's happening. We can't get what we need in the region. Well, they immediately got in touch with the governor, who started moving the roadblocks that were in place, and lo and behold, that allowed us to grow further in this region, not leave the city, not leave Pennsylvania, and PNC was a key part of that. And since then, we've doubled those facilities and are in the midst of increasing by another 60% now. So without PNC stepping in to remove roadblocks for us, our footprint wouldn't be nearly as significant in this region as it is now.
Bill Demchak sees support for companies like Perryman as the core of his business, a basic banking business serving customers and providing credit for key parts of the economy, knowing when and how to take risk, and avoiding growth for growth's sake.
Maybe it's part of our Pittsburgh roots, but what I've come to understand in all the years I've worked is banking really is 3 yards in a cloud of dust. There isn't a magic answer. There isn't something that's going to cause you to, you know, as we've seen, double and triple in size safely. It's hard work. It's sticking to what you know. It's being relevant to clients. And importantly, you know, if you talk to our investors, they say, yes, you know, PNC is very prudent, well risk managed. We've had the lowest charge-off rate on credit, you know, versus our peer group for the last 20 years. But we'll take strategic risk, you know, from the sale of BlackRock and the purchase of BBVA right in the middle of the pandemic. So we're lower risk in the traditional sense, but at the same time, we recognize the changes going on in the banking industry and where we want to play and how we need to adapt to that.
In the spring of 2023, regional banks were put in the spotlight by the failure of Silicon Valley, Signature, and First Republic banks, with questions raised about whether they were inherently more risky.
What hit the news was then this notion of, regional banks as a group are in trouble, and the G-SIFIs, the giant money center banks, are safe. And you saw market share move to the larger banks during that period of time. Some of that was fair in the sense that people said, look, if I put my money at a JP Morgan, government will never let them fail. My money will be safe. And that's unfortunate because the descriptor of smaller necessarily being more risky is just fundamentally wrong. But I understood the mentality.
Former Federal Reserve Governor Dan Tarullo agrees that it was a mistake to lump in a bank like PNC with smaller versions of regional banks. And Tarullo worries that the smaller regionals may get caught in a squeeze.
So I think here's the dilemma, David. On the one hand, the regional banks that I'm talking about, the group between 70 and 80 billion and 220 billion, are in a business model squeeze. They cannot compete with the PNCs and USBs of the world, much less with Chase Manhattan and Bank of America. They just don't have the scale to do it. Scale is becoming increasingly important as digitization, tech, and eventually artificial intelligence become important parts of the banking business model. On the other hand, what's left of genuine relationship banking, that is, banking in which subjective judgments about a potential borrower's position and ability to repay are of significant importance, where it hasn't mostly been reduced to numbers. That's where the community banks, the smaller institutions, not just the under 10 billion, which are the technical community banks, but 14, 18, 20, $22 billion banks, that's where they have an advantage. And I think it's that group in the middle, which has neither the scale nor the capacity to be true local relationship lenders, that are facing the squeeze. And I don't think it's a coincidence that those are the banks on which people feared runs a year and a half ago.
PNC's Bill Demchak agrees that regional banks like his have a vital role to play, but he's not sure that regulators have figured out what it is.
One of the things I've asked all of the regulatory groups what their vision of banking is. And more often than not, they'll say, that's not my problem. Our problem is to keep banks safe. And if you point out to them the change in the banking landscape where, a JP Morgan over at Bank of America have organically grown a PNC every 3 years. They're, 6, 7 times our size, even though we are, as an institution, if we just do what we're doing today, I think you'll have 3 or 4 banks that'll consolidate the whole country, with the exception of true community banks, which I think everybody up and down agrees, as do I, serve a really important purpose in our country.
Whatever the role of regional banks ultimately proves to be, bankers like Bill Demchak doubt that the current approach to bank regulation accomplishes what it's meant to.
In the end, and I don't think we need this, but if they said, the banking system just needs more capital because we'll sleep better at night, I'd rather have them just say, hold more capital, but then get out of my hair so that they don't tell me how I'm supposed to allocate it. We know how to allocate it. That's our business. All of the rules they hit you with ultimately cause all the banks to kind of look the same based on whatever the Fed models say, which aren't always the right models. It's a problem. I think we're long past a world where bankers are high flyers and are trying to bet on red. I think that ended definitively in the financial crisis. I worry more about, by putting everybody under the same microscope with the same models, we're replicating the same problems across the entirety of the system. If the Fed says in a stress test that this type of loan is bad, then nobody will do it because regulatory capital is too high. Fed says this type of loan is good. What if it isn't? Everybody does it because the Fed said so.
If regulators are looking for systemic risk to address, Bill Demchak suggests they look at the movement of assets outside the regulated banking system to the non-bank banks, in part because of their growing codependency with other financial institutions.
The shift of assets outside of the banking system, leverage lending and mortgage, we miss opportunities. Leverage lending isn't our core target. You know, our clients are right there in Pittsburgh or Cleveland or Texas, and they're real companies, and they're not necessarily catered to private equity or other buyout funds. But down the road, it matters. I think mortgage matters a lot.
Increasingly, we see the non-banks doing business with the banks. They're banking with the banks. Is there a potential risk in that? Basically, that it could, what has been thought to be a non-systemic risk, could actually get into the system, particularly if we're not able to see what's going on?
Yeah, it's a really good question. You will probably remember having seen recent comments and FSOC notes, if you read that stuff, where the regulators are starting to say, wait, where's the interconnectedness here? And you know, all of the shadow banking system, you know, if it's still called that, from the retail lenders through to the leverage finance lenders through to hedge funds, they exist because banks provide liquidity to them. So we empower, you know, think about what's happened to the mortgage business. I think 75% of it has left banking and gone to not terribly well capitalized or funded institutions, and then banking provided them with liquidity lines for their warehousing. Things get bad, all those liquidity lines go away, and they're left hanging. So it's the right conversation to have. And if you look specifically at that outcome, is that a good outcome? I moved it out of the banks still finance it all. I don't have line of sight into it anymore. But you know, I feel great about the banks. I just don't necessarily feel great about everything that now is non-bank that I pushed out of the system. And we'll have a day of reckoning with that at some point.
Whether you talk with a former regulator like Dan Tarullo or a banker like PNC's Bill Demchak, the future of regional banks looks like it will lie with further consolidation, something that raises its own issues with integration and, of course, pricing, but that could make the system stronger if done right.
As a group, those banks do play an important role in providing credit to mid-size companies, non-financial companies. And obviously, we want a very competitive market so that the mid-sized businesses have pretty good credit terms. The question, I think, is, you know, can that role be served by the super regionals? And my inclination is to say that I think it can. I think it already is to some degree being served by the super regionals. And if that's the case, then maybe we should contemplate a banking system in which there are not 4 super regionals, but 8 or 9 or 10, where there's an achievement of economies of scale, but they're still basically commercial banks, and they're still catering to the mid-size and medium-large businesses that these banks do today.
I think consolidation has to be a big part of the future of banking. One of the challenges everybody faces in this world of increasing technology spend in cyber and what clients expect in terms of the product delivery makes it hard for 2 medium-sized banks to get together and be anything other than larger, but not necessarily be any better. You know, it gives them perhaps an expense platform where over multiple years they now have more to invest, but they're at a structural disadvantage.
But whatever further mergers or acquisitions may lie in PNC's future, its CEO, and at least one of its longtime clients, believe this regional bank will retain deep roots in Pittsburgh. And that's where we turn next, to the role of regional banks as citizens of the communities they serve, and the prudence that can come with that grounding.
When you look at Pittsburgh, it's big city capabilities, but small town strength. So it's a great combination of you can trust who you're with. And, you know, you don't always get that in big cities.
The nation's regional banks are, first and foremost, just that, banks. They provide financial services like lending and payments for their commercial and private customers to help them get to where they want to go. As Bill Demchak explains it, PNC's recipe for success requires staying true to its roots in the Steel City.
I don't know why we'd move to New York. We started in Pittsburgh back when U.S. Steel started in PPG and Alcoa, competed with the old Mellon Bank, and grew up with them. And we're more of a traditional bank. Our business model is national, but what we do in each of the markets where we operate is the same thing we do here in Pittsburgh.
So what's so special about this northeastern city of just over 300,000 people? And what can make the difference between a town faltering on the brink of collapse and one bent on recovery? For that, we look to its history, its culture, and its sports.
We've been fortunate to be in this community now for over 90 years. But I have to say, I think things changed for the city and for our franchise in the 70s when we had the great teams. And really the time before that was pretty much some rough times for the Steelers. But things turned around in the 70s, and it was at a time when the city and the region was really going through some hard times in terms of the steel industry and related businesses collapsing around us.
When it comes to Pittsburgh, you can't talk about the city without talking about the Steelers. Founded by the Rooney family back in 1933, and now led by Art Rooney's grandson.
The Steelers were kind of what people held on to at that time, and a lot of people left the area, over that period of time, and so that sort of started the Steelers Nation being spread out, all across the country. And so it's been, since the 70s, it's been a great run, and we've had a lot of success, and we think we have the greatest fans in the league. People identify with the blue-collar aspect of Pittsburgh, and I think that's a great fit with the sport of football. Football, you could say, is kind of a blue-collar, get knocked down, get back up kind of sport, and I think particularly people that hail from Pittsburgh or their families came from Pittsburgh, that appeals to them. And so I think that's been part of why our fans have grown, and now we're into new generations of Steeler fans that came from families that had to move out, and hopefully some of them are now moving back.
The football team's name points to the steel industry that, along with other manufacturing, created family fortunes that continue to support the civic life of the city today.
One of the legacies of the steel and manufacturing era are the foundations that we have in the city. The Mellon Foundation, the Hillman Foundation, and I could go down a list of foundations that grew from the money that was generated back in the manufacturing days. And so those foundations, for one thing, have supported sites like our facility is on today. It was bought by some foundations to convert a brownfield into now a fully developed site. So we just have some great institutions that have also become part of the foundation of the economy here.
Pittsburgh's a city that was built for a population that's much larger than it is today, whether it's the size, it's the infrastructure, the cultural district, the sports teams, and importantly, the foundations. One of the things that is really unique about our city is a lot of the industrialists, back 2 centuries left, so Carnegie, Heinz, Mellon, Hillman more recently, large foundational support for the city, specifically targeted at the city in the future. So when we imagine, a community and government and partnership build of, hey, we need to change something. We're gonna revamp the cultural district, or we're gonna reimagine downtown, or even the draft is coming next year. We have that backbone, which is pretty unique, to be able to kind of all pitch in and go after that.
Those foundations left behind from Pittsburgh's Rust Belt past are now investing in the heart of its downtown, helping to support the arts and creating a special area in the center of the city. Kendra Ingram is the person overseeing it all.
One of the really unique things about Pittsburgh, and I think one of our greatest gifts, is that we've been the beneficiaries of historically philanthropic families in Pittsburgh. So the Hines family, probably being one of the biggest for the Cultural Trust, they can really be credited with starting the trust and starting the project to turn a red light district in downtown, that's literally what it was, to this thriving 14-block cultural district. The Hines funding really helped the trust to buy a number of properties, particularly ones that had a bit of noxious use in the cultural, what is now the cultural district, and turn it into a much better space. They also invested in restoring a number of the historic theaters in that district, which is now the cultural district. We're sitting on one right now, this amazing Benedum Center that was initially, I think it was built in like the early 1920s. And the Hines Endowment's funding really enabled the restoration of this space. In addition to that, the R.K. Mellon Foundation and the Hillman Family Foundation have also been major contributors, not just to arts and culture, but really to vitality of Pittsburgh. So these major funders that, frankly, a number of our colleague cities around the country don't have, has allowed Pittsburgh to be a thriving city that I like to say punches way above its weight class when it comes to arts and culture, recreation, and just general quality of life on the city. It is an awesome place to live and be, and it's largely due to those philanthropic families.
As important as the funding of the local family foundations has been, Pittsburgh has built a broad base of private and public funding to support its cultural institutions.
One of the things that's unique to Pittsburgh as well with funding is our regional asset district. So that is a fund that comes from a county tax that goes directly to funding arts and culture and civic spaces, parks in Pittsburgh. That is a huge opportunity for arts and culture organizations to have operating support in addition to private support from foundations. So when we look at doing projects like downtown revitalization projects, we have a number of partners who already have seen the investment that they have made has been so significant to, again, have Pittsburgh arts and culture punch above its weight class, that it makes the case already for future funding of transformational projects like a downtown revitalization project.
Pittsburgh may not be the biggest city in the country, although it's far from small, and it may not be the fastest growing, though it's getting bigger. But it's steering a middle course based on strong partnerships of business and community, and yes, of a strong regional bank within that community, creating one thriving part of the U.S. economy. And PNC's Bill Demchak says he wouldn't want to do it anywhere else.
We're part of the community. We're part of solving the problems in the community and helping our clients in the community. New York does nothing to help that. Probably makes it harder for our employees to commute in and out and so forth. So we're happy. Pittsburgh's our home.
Next, the billions of dollars we spend to keep our pets healthy here on Wall Street Week. This is a story about companionship, the kind that 87 million households enjoy in the United States. It's the kind that can come only from pets. And Americans are willing to pay a good deal of money to make sure they can have it for as long as possible.
You look at some of the incredible studies on this, 86% of pet owners would spend whatever it takes to take care of their animal if it was sick. And we said, okay, what if there was a 20% reduction in your take-home income? Would you change what you spend for your pet when it's sick? And they wouldn't change it a dime. It's a member of your family, and I think that really does change what you're willing to spend, as well as the conditions that you're really going to pay attention to.
That's Kristin Peck, CEO of Zoetis, the largest animal healthcare company in the world. And she knows whereof she speaks. Last year, Americans spent $38 billion to keep their pets healthy, up from $14 billion a decade ago, a jump of 170%. That's more than people spent on gym memberships, and twice what they spent on takeout pizza or going to the movies. There's also a big business in the health and welfare of livestock, but it's the pet side of things that's showing the most growth. Pfizer spun off Zoetis 11 years ago. It's gone from focusing mainly on livestock to dedicating the lion's share of resources to our pets.
It's evolved dramatically since our IPO about 11 years ago. Back then, we were 65% livestock, 35% pet care. But we've really invested aggressively in science-based innovation, and now it's actually flopped completely. We're now about 65% in pet care and 35% in livestock.
The overall animal healthcare business grows between 4 and 6% a year. But since its IPO, Zoetis has averaged a compound annual growth rate of 8%, something Kristin Peck attributes to investment in research and development to create new treatments.
That difference is really the science-based innovation that we bring, bringing new treatments to new unmet medical needs. And as I look to the future, there's no reason that should stop. There are significant unmet medical needs across both companion and livestock. Major diseases such as chronic kidney disease and renal disease that right now has no treatment for cats and dogs.
In beating the market, as you have done, how much of that is organic, I would say, internally generated as opposed to acquisitions?
So almost all of it for us has been organic. We look very closely to what are the customer needs across the globe and meeting those needs. We have a very large R&D organization. We spent $5 billion in R&D, for example, since we IPO'd, and our R&D expense grows double digits. We're really excited to discover the future of what animals need.
Discovering that future and creating it could be the core of Zoetis' success story. And it's the purview of Rob Polzer, the man who oversees the firm's R&D efforts from its headquarters in Michigan.
R&D within Zoetis represents about 1,500 colleagues across the globe. Nearly 1,000 of those colleagues work here in Kalamazoo and in the Richland Farm area. And it's really at the core of the innovation for the company. So we really pride ourselves as a company to develop innovative medicines that are based in science. And the R&D function is really key to bring those new innovations forward to marketed products for the company.
Like other drug makers, Zoetis has made a business of taking big risks in the hope of earning big rewards. Take, for example, Zoetis' treatment for dermatitis in dogs. Historically treated with steroids until Zoetis made a substantial investment in a new way to address the problem at its core.
R&D did a lot of the basic biology to understand, well, what is causing itch within dogs? Can we intervene safely? And the answer was yes. So through that research, we identified that the JAK pathways, it's a Janus kinase, it's a group of enzymes, were responsible for sending out chemical messengers in the body of the dog that made them itch. And through the work with our chemists, we designed a molecule that blocked that communication, that messaging pathway, and ensured that we had the right product profile, because we wanted to be able to treat seasonal allergies as well as chronic itch in dogs. And through that process, spent about 7-8 years developing that product, getting it to the regulatory authorities, and eventually getting it on the market. And now, after 11 years and 28 million dogs treated, I think we have a lot of happy customers and less itchy dogs out there.
All that is good news for 28 million dogs, but also for Zoetis' bottom line, after it took the risk and invested in Rob Polzer's research team to develop a new product based on an assessment of the likelihood of success and the possible payoff. As a CEO, perhaps your most important job is allocation of capital.
Yep.
How do you decide how much capital to allocate toward R&D?
It's a robust process. I get this question a lot from investors, like what's the right amount and how do you know? And as we've talked about, we spend a lot, over $500 million a year in R&D, and we've been growing that number double digits. And that's because we've had an incredibly successful R&D engine. And we have a rigorous process where every project gets prioritized. It has a expected return on investment, and that's based on the probability that technically that program will be successful and that there's a regulatory pathway to make it successful. And we prioritize all those, and then we come up with an answer. But we don't stop there, because there may be some big bets you want to make that you're not really sure what that value is going to be. I'll look at, for example, dermatology, back when we launched the product in 2014. Vets were like, steroids, they're fine. They should be fine. It was a $100 million market. How valuable is that going to be? Maybe it's $100 million. So sometimes you've got to make bets because you really believe, even if the market doesn't see it today, that you think that's going to be big. That was the right bet. $100 million market in 2014 is now a $1.5 billion market, of which we're more than $1.2 billion of that.
Zoetis and others weighing the costs and benefits of research bets now have a new partner in the form of artificial intelligence, something that experts like Dr. Casey Kaiser of Cornell say is one of the most significant additions to the field.
I think there are several new exciting developments in terms of drugs and treatments available for pets and in veterinary medicine in general. And a lot of those are actually using artificial intelligence to help develop them or create them. For example, there are a lot of new efforts to create diagnostic tests using artificial intelligence that can do things like tell if a dog or a cat has kidney disease earlier than we currently can, or look at radiographs or x-rays and help us diagnose things like hip dysplasia in dogs, which is a degenerative and genetic condition. Other people are using generative AI, which is like ChatGPT. So the Cornell University Feline Health Center has created a Cat GPT, which provides cat owners with helpful information online about their cat's health so that people have a reliable resource to go to rather than just Google.
As much as we anticipate that artificial intelligence is going to help us around the corner in diagnosing humans, Kristin Peck says that in animal healthcare, it's already being used extensively and with immediate results.
People talk about the future being AI. The future is here in AI in animal health. And we have multiple applications that we're currently using, at the vet and with the pet owner. So the Images platform, for example, is really fascinating in that we partnered with a company called TechSite. They had this technology where they believed firmly that they could take a really good picture and then you could use AI to compare it. But we had all the data, right? We have all the samples where we could train the AI with blood samples or with fecal samples to help it learn faster. And so it was really the partnership of a sort of AI company with the biology, the chemistry, the science that Zoetis had. And now we have 6 indications on this one platform. But we're looking at other applications of AI and using them today. So one of the things we hear from our customers is that it's so hard to get your cat in a carrier and get it to the vet. And if you don't know that there's a treatment or know your cat has it, is it worth it? Well, you can now upload a video of your cat walking around your house, going up the stairs, and you can upload it to Cat Pain IQ, and we can tell you the likelihood that that cat has osteoarthritis and whether it would be worth it to bring your cat in.
So what's next for animal healthcare? Cornell's Dr. Kaiser says she's focused on trying to fix a problem that we created ourselves, resistance to antibiotics.
I'm looking at that in both animals and human species. So I'm particularly excited about how we're paying more attention to how antibiotics are used in our pets and our dogs and cats. So I think historically a lot of us have focused on resistant bacteria in people and also in livestock, and we've kind of ignored the animals that are sleeping in our beds, living in our houses, and licking our faces.
Back at Zoetis, Rob Polzer is turning his research team to focus on cancer and on kidney diseases.
So on a therapeutic area perspective, a lot of advances in oncology. So not surprising, I think, to many of your viewers, immuno-oncology has really advanced on the human health side to treat cancer. Certainly that's a space we're interested in on the animal health side in canine. Renal disease is another, critical disease in both dogs and cats. And what we see is that, for older cats, typically by the age of 13, about 80% of cats will have some form of renal disease. Older dogs have, about 10% of that population face renal disease. And there's no good therapy out there. Most of the approaches today are to try to go and manage the clinical symptoms that are occurring from renal disease, but actually not slowing the progression of the disease.
Polzer and others see a bright future for animal healthcare. And underlying it all, the research and the investment in the large and growing market is the emotional attachment so many of us have to the animals in our lives, an attachment that drives the business.
I think it's true. I mean, one of the examples I give is what you're willing to spend on your animal when it's in your backyard versus when it enters your house versus when it sleeps on your bed is just different. And I think, maybe 20, 30 years ago, a lot of the animals spent most of their day outside. They entered your house. Now that's interacting with your family, and you want to make sure that you're protecting against diseases. It goes regularly. Well, now that it's on your bed, you're worried about its emotional well-being. You're paying attention to different things, and the animals are living longer.
And maybe that's why leaders in the industry, like Zoetis' Kristin Peck, have a lifelong attachment of their own to animals.
I love our purpose as a company. I grew up with animals my whole life. My family raised horses, and we had 4 dogs and cats and birds. My first job actually was for a company called American Equine Products when I was in high school, which is, believe it or not, a legacy Zoetis company in the small world. So I don't know that I thought when I was little and I loved animals that that would be my career. But when I saw our purpose, which is to nurture the world and humankind by advancing care for animals, I was a business person with a finance background in private equity and consulting. It really spoke to me.
Social mobility in a land of greater inequality. That's next on Wall Street Week. This is a story about opportunity. The opportunity to succeed in life on your own merits, to do better than your parents by working hard and playing by the rules. Something the United States, the so-called land of opportunity, has long embraced, and something that education was supposed to help provide.
You are investing in helping people better their lives when you invest in people's education. And in turn, that means that they are bettering the lives of the people around them.
Heather Kuhlman works at Amazon, and she's living the story of upward mobility, thanks in large part to her employer's Career Choice program that made it possible for her to complete an associate's degree and earn a BS while working full-time and raising 3 children. But the United States might be less of a land of opportunity than it used to be. In his book, Ours Was a Shining Future, David Leonhardt reports that the likelihood Americans would make more than their parents went from 90% for those born in 1940 to 80% for the boomers born between 1946 and 1964, to just 60% for Gen Xers, and all the way down to 50% for the millennials born between 1980 and 1996. Dan Porterfield helped run Georgetown University, was president of Franklin and Marshall, and now runs the Aspen Institute. He says there are obstacles to opportunity, but changes in higher education are a big factor.
The role of higher education in enabling economic mobility has been threatened over the years. One reason why is because of the rising cost of tuition. Another reason has been that the middle class has found some parts of higher education to be unaffordable. And then finally, one of the issues is that lower income people have not always had confidence that college is there for them, and so really talented students have not been applying as much as they might in earlier years have done.
When lower income students do decide to apply to college, the system they confront does not always welcome them. One man trying to change that, Michael Crow, president of Arizona State University.
So the model for the new American university is built around this premise of, can we build a new kind of institution which is simultaneously very, very accessible, egalitarian, that is, families from every socioeconomic background can come into a modern, high-intensity, discovery-oriented, creativity-oriented university, and those things don't have to be separated. So right now we have universities that have gone off and become very much measured by who they exclude and the quality of their research, and then there's other universities that have become very much measured by just being the most efficient machine that they can be in terms of producing students. And so in our case, we're trying to, which we have, make the point, prove the point, and demonstrate the model that you can build an institution deeply connected to the fullest spectrum of the population possible to move them forward from an educational perspective, while at the same time creating for them an educational opportunity and a learning experience equal to that which any other university can put together.
There was a time when the United States led the world in education innovation with the creation of public land-grant colleges in the 19th century, by making public high school mandatory in the 1920s, and then passing the GI Bill to allow soldiers coming back from World War II to get a college degree. But Michael Crow says that over the decades, the U.S. became too complacent.
We began to become self-satisfied with our model as the country continued to grow and the world continued to complexify. And so we didn't build for scale and we didn't build for complexity in the way that we should have. And so we stopped innovating at the rate that we should have kept innovating. What's happened is that more than half the students that go to a university in the United States never graduate, so that's unparalleled among the industrial countries, number one. Number two, it turns out that you've got universities that have become so selective where everybody graduates from those places because the students are hand-picked. They also get a huge amount of the resources. And then you've got other universities in which most people don't graduate. And so then you create this this expectation frustration. I sent my kid to college, they encountered debt, they took on debt, and they didn't graduate. So the debt crisis is, in my view, not a debt crisis. The debt crisis is a graduation crisis. The debt crisis is a performance crisis.
If students are frustrated about the prospects of making it all the way through college to get a degree, they have good reason. Although the percentage of Americans receiving bachelor's degrees has steadily risen since 1960, less than 2/3 of those starting out manage to get a bachelor's degree within 6 years, with the numbers for private for-profit schools much worse than public or private nonprofit universities. To improve the odds, Arizona State has built an educational gateway for students across income ranges that's very different from what most schools provide.
So a few years ago, we had an engineering school of about 6,000 students. We weren't doing very well in freshman retention. We were in the old weed out mode of thinking about engineering. We decided to change everything. We graduated about 900 engineers a year. This was about 13 years ago. We decided to change everything, change culture, change design, change intellectual structure, use technology, move in new directions, and then we began measuring learning outcomes, finding new ways to teach math, new ways to teach calculus, new ways to teach biology, new ways to teach chemistry.
Congratulations, graduates.
Last year we graduated 7,200 graduates in an engineering school that's not 6,000 students, but 32,000 students. Its level of research activity has accelerated, its level of excellence has accelerated, and the market value of the students coming from the school are greatly altered. And so the measurement is measurement of everything. Learning outcomes by student, learning outcomes within certain courses. Graduation success is changing everything. So in fact, it is the measurement of everything that is a critical tool in driving one to innovative success here.
If graduation success is the ultimate goal, exclusivity in admissions is not necessarily the best way to get there. Arizona State has greatly expanded the size of its student body, and in the process, the path for those coming from lower income households.
The notion of success through exclusion, success by who you don't admit, the measurement of success by how many people you turn away, that's not a theme for a public university to be maximally impactful. So what we've done is we found a way to say, you know, if you work hard, if you study hard, if you get prepared, if you're willing to do some things, if you work with our tools, we'll find a way for you to be successful at the university, and we're not going to turn you away. And it turns out, by the way, that smallness is also a narrowness in thinking, a lower probabilistic set of potential creative outcomes. And so we think that you can have small colleges and small programs, certainly, but smallness doesn't really mean anything in a country of 345 million people.
Smallness is not a problem at ASU. By some counts, it's the largest university in the United States, and since 2000, its enrollment has nearly tripled. Much of that growth has come from students outside the campus walls, and the Aspen Institute's Dan Porterfield says that's not a bad thing.
Online education can be a component of learning of all types, from early education through adult learning. And in fact, that in the workplaces of today and tomorrow, more and more people are going to lead their own learning through online platforms. I think AI might make online learning more personalized. So I don't fear it, I welcome it.
Certainly, Heather Kuhlman took advantage of the online opportunities at Southern New Hampshire University when she pursued her 2 degrees while working at Amazon.
Being able to go to school online and not have set times for my classes where I didn't have to be here at 2 o'clock, instead I just had deadlines, was much more beneficial for me.
Well, I mean, if you think about it and you think about your life between, let's say teenager to your 80s, 90s, or 100s, or however many years people are going to live in the future, you're going to need access to advanced learning in one way or another across the entirety of your life, and it being delivered to you wherever you are, whenever you need it, however you need it. What's going to happen with online education as it is improved and enhanced and run by real faculty, like our faculty run all of our online programs, design all of our online programs, as the quality goes up, it's going to become a mainstay. It's going to be, you're not just going to watch television when you go home. You're going to be involved in these learning activities. You're going to do this. You're going to be involved in immersive experiences that are digital. We, for instance, now have 9,000 biology majors at ASU, half online, half on campus. And what we're finding is that the learning outcomes of all these biology majors are about the same, which is a tremendous outcome.
To make sure that those who start out with less can move up the socioeconomic ladder, places like Arizona State are delivering and are keeping track of just how well they're doing.
And so what we found is that The ROI for our degrees ranged between 7% per year and 23% per year, depending on the degree, all of which are substantial returns. The average ROI for us is 14% ROI per year after you attain your degree. That's a substantial return on your investment, just looking at it from a simple business investment perspective. We also know that life outcomes are significantly positive, health outcomes, education of your children, happiness indicators. We've looked at all of those things. So we measure all those things. Now, the system's far from perfect. I think almost 400,000 people have graduated from ASU since I've been the president. And I can't say that all 400,000 people are living in nirvana. But what I can say is that we have created a mechanism by which people from every family background have access, if they want it, to a pathway for which they will get substantial return on their time and treasure investment in attending the university.
Economic and social mobility has long been a point of pride in the United States. But continuing to promote that mobility through education has gotten harder over time. Nonetheless, people like Michael Crow and Dan Porterfield have learned from personal experience just how important that education can be in beating the odds.
What drew me in this direction was through reading as a child. I had a highly disruptive childhood. I grew up in a working poor family, first person to ever go to college in my family. And what I found was that once you began to get educated, all things changed. But the thing that really drove me was I grew up in schools where, in neighborhoods where lots of people didn't have opportunity. And what I could see was all of the wasted talent. So to me, it was about the main driver is we haven't even begun to unleash the potential of our species or our country.
Something that's critical for young people and their parents and families to remember is that each student, wherever they go, has the opportunity to create the education that they seek. You can't buy that, your parents can't give you that, you can create it.
Ultimately, it's up to each student to achieve their goals. But it's up to the rest of us to make sure they have a full and fair opportunity to do just that, ensuring not success, but the path to success. Next on Wall Street Week, Darren Walker's very personal story of social mobility and how it allowed him to rise to lead the Ford Foundation in a quest for social justice.
Most economists who study social and economic mobility in America over our history would now conclude that the mobility escalator has slowed and has in fact stopped for some. And that's deeply problematic. And I was able to get on that mobility escalator. I was a poor kid, a single mother born in a charity hospital, never knew my father, but I lived in a country that believed in my potential and invested in it. And I was able to get on that mobility escalator without care or concern about the cost of education being a barrier, without care or concern about my ultimate success if I worked hard and sacrificed and played by the rules and didn't get in trouble. And I think for a lot of people today, they don't see that mobility escalator so close. In fact, it feels remote to them. And we have to do the work that we need to do to give those people hope and to have the kind of America that is indeed an opportunity society, because we know that talent is spread evenly, but opportunity is not. And it's up to us, particularly those of us with the kind of privilege that we live with, to understand how difficult the life is for so many of our fellow Americans, and our obligation to not just be about me and my success, but about our country's success.
Part of what drove you in your upward mobility was education, the availability of education, a first-rate education. Is that changing? Has it changed in the United States? Is that part of the problem?
Well, again, we know this is a part of the challenge. I proudly share the news that I have never attended a day of private school in my life. From Head Start all the way through law school, had a great public education. And I'm very proud of that because I think that speaks to the idea of education for all in a democracy, and particularly in this democracy. And the fact that our education system is unequal is a contributor to the degree of inequality we see and the way certain populations are consistently, intergenerationally left out and left behind.
So Darren, you're nearing, not at, but nearing the end of a distinguished tenure running Ford Foundation. Looking back on it now, what do you think you accomplished?
Well, I hope that we accomplished several things. First, elevating the challenge of inequality. We were among the first philanthropies to articulate inequality as a problem for our society, for our democracy. That was very important. Secondly, to elevate the issue of technology and its potential impacts, both positively and negatively, particularly on people who are poor, who are disadvantaged, who have historically been marginalized in American society. And thirdly, to introduce the idea of social justice philanthropy, which is different from normal philanthropy as we've thought of it going back to Andrew Carnegie. Those are three things I think we've accomplished and that I'm very proud of.
You changed the direction of Ford Foundation when you came in. There was a lot of talk about, a lot of coverage, specifically with respect to justice, focusing on justice, as well as inequality. One cannot change without meeting resistance. Where did you meet resistance?
Well, I think there are entrenched interests in the status quo in any legacy organization, whether it's a major Fortune 500 legacy company or a major foundation like the Ford Foundation. And what you have to do is take on those entrenched interests and name the problem, name the barrier that they have erected to progress, to forward movement, and really take it on, head on. But importantly, you've got to have your board of trustees in alignment. There is nothing more important in an enterprise, whether public or private, than alignment between the chief executive and the board of directors. And I was very lucky from the very beginning to have had a board who I share values, who appointed me, I think, because my vision they were inspired by and wanted to support.
How do you measure your success?
That's a great question for a foundation like the Ford Foundation. We're not Gates or a science-based foundation, so we don't invest in disease eradication or agricultural science where you can have randomized controlled trials to indicate progress. We invest in justice. So how does one measure justice? Because it's hard at any one time, like with a disease eradication, to declare victory. How do you declare victory? We could have declared victory on the progress around reproductive health for women many years ago. But here we are, again, at a seminal moment of retreat on access to abortion and reproductive justice. And so we measure impact by the strength of the institutions who we invest in and their preparedness and resilience to continue in the face of resistance. So for us, progress looks like, in the area of reproductive justice, a strong Planned Parenthood and other organizations who are litigating, advocating, developing policy response to ensure that ultimately we do live in a society where the idea of reproductive freedom is normalized and is the law of the land.
Justice is a big idea. It's been around since ancient times, the quest for justice. Can even the Ford Foundation, as big as it is, and influential as it is, can it actually move the needle on justice in our society?
Well, I think we in philanthropy have to approach our work with great humility. No, the answer is the Ford Foundation alone doesn't move the needle. The Ford Foundation, hopefully in collaboration and supporting and in partnership, can make some progress. But we philanthropists sometimes approach our work with a degree of self-satisfaction or a degree that we're right, and it's a trap. The rural villages of Africa are littered with the carcasses of development projects funded by philanthropists who didn't understand that the people closest to the problems should be in charge. The design of strategies and approaches is not only to be left to the experts and the credentialed PhDs, but to people who are in these communities and in partnership with them, developing the responses to the problems that they identify as their priorities. I am an unapologetic capitalist. There is no better way to organize an economy, but we have to have a capitalism that generates shared prosperity, because from shared prosperity comes a society where hope lives.